Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello, and welcome to this week's episode of Market Talk. I'll look back on the week's events, just pointing out some of the key components of the week just gone, the market moving news and data, and we'll also give a quick preview of some of the key events coming up over the course of the next week. Helping me through what we've seen and what's to come will be Sam Cutler, Portfolio Manager at 333 Capital. Hello, Sam. How you doing?
Hey, Harry. I'm all right. Yourself?
Cool. Well, yes. Yeah, apart from a bit of a dodgy year, then we're all good. And that's for another time. Just before we get going, a quick disclaimer. As always for this stuff, it's boring, but it's true. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Right, we're recording this on Friday, the 22nd of August at just past 4 o'clock in the afternoon, London time. That's just after 11 Eastern time, Eastern summer time. And so we've just had basically an hour before, we've just heard from Fed Chair Powell at the Jackson Hole Symposium and his much awaited speech. And we're going to really focus on that as much as anything else, really, because that is what everyone was waiting for this week, really. I'm going to pass over to Sam. Sam, what did you make? I mean, we'll go into some of the comments in a minute, but what did you make of Fed Powell's comments?
Yeah, I mean, I find it a little interesting. To me, it's like I don't really understand what the past 4 months were for him, because he caved here, it seemed like. It was a very dovish script. And, that comes on the back of yesterday that we got, not yesterday, I'm sorry, on Wednesday, that the FOMC minutes were relatively hawkish, I would say. And I think you saw the market starting to hedge that starting Wednesday, continued on to Thursday, hedging for, okay, maybe we're going to see a little bit of a much more hawkish Powell, a little more focused on his, legacy of really killing inflation. Kind of like we saw, in 2022, where I think markets that day were down. I think the S&P was down like a little over 3% intraday back in 2022 during his speech. So I think you had a little bit of fear creeping into people there, and you kind of saw that hedging take place. And I think this speech is kind of viewed as a pivot, and everyone was hedged coming into this, so it's a recipe for kind of a rip in risk assets, which I think you see here. Indexes are up huge, the Russell's up well over 3% on the day. Rates are rallying. Twos to almost the 5 years are up. 10 down 10 basis points on the day. The curve steepening. So I think this was kind of a pivot. And the only thing that I can imagine here is that last employment report must have done something to them. And I think if you look at it, prior to that last employment report, the 3-month average was what? I think we were right around 150,000 jobs. And after this last one, now it brings it all the way down to the 3-month average of 35,000 jobs. So I think they are a little concerned with that. And if you go through some of the things he said in this speech here at Jackson Hole, it kind of makes sense. And for me, I took this, he solidified pretty much a cut in September. Now, I know we have another CPI print and we have another payrolls print, right? So I think there's going to be some big emphasis on the payrolls print, but more or less, he pretty much set the stage for this 25 basis point cut in September. He said the baseline outlook and the shifting of the balance of risks may warrant adjusting our policy stance. So I think that's pretty much him, paving the way to say, okay, we're going to adjust policy at the next meeting. He also then said the stability of the unemployment rate and other labor market measures allow us to proceed carefully as we consider changes to our policy stance. So again, I think that's just another talking point of his that feeds into opening the door and communicating to the market that there's going to be a September cut. On the labor market, he had a little interesting comment here. He said, appears to be in balance, but it's a curious kind of balance that results from a marked slowing in both the supply and demand of workers. And the unusual situation suggests that downside risks to unemployment are rising. Now, I think this is a big thing, and we've talked about this before, of how kind of the supply and demand curve has changed post-COVID, right? Which has created this kind of a different labor market than we've had. And now you also have, the immigration with the labor force coming down. That's like naturally, artificially, I should say, suppressing that unemployment rate. But on the last go around, we spoke about this, right? We actually saw unemployment coming out of the household survey with the unemployed and the rise in the unemployment rate. And unrounded, it was what, 4.48 or something. So almost rounding to 4.3. So I think that's going to be, a key focus for them moving forward. He did also say some interesting things on, tariffs, how they create a one-time shift up in price levels, but it takes a long time to work through the economy. So that tells me.
I was a little bit confused by that. I was a little bit confused. Well, not confused because that's not an uncommon thought that
no, but I think the way I would simplify that is, he basically is saying monetary policy is kind of facing some supply shocks. So you kind of have to remain focused on the longer term expectations and kind of not the short term bumps here, right? So if you're looking at, market-based inflation expectations, right? Not survey-based, like we'll stay away from survey for now, because I think there's a lot of randomness in the survey stuff, especially, the UMISH, like the politicized spreads on those. But if you look at market-based, right? Like, yes, the 1 year inflation swap's a little volatile. It's, at 341 right now. But the 2 year swap's been, relatively contained for the past 3 months, hovering right around that 3% range. The 5 year swap's a little lower, been hovering right around that 260, 270 range. So I think that's what they're kind of focused on, looking on a little bit of the longer term expectations and focusing on these short term bumps. Because if you look at month over month inflation swap pricing, we're starting to see the steep change in prices come through in September. The current swap pricing on that is for 0.45 print month over month. So that's pretty high, right? That would print rounded to 50 bips months over month on inflation. And that's kind of the highest point in the curve here. Then October, it drops a little below 0.3. November spikes back up above 0.3. December prints back up into the mid 40s. So there's a problem here, though, because the result, if let's say that does come, if let's say that September print and inflation is high, that rises year over year to above 3%. And the way that's annualized, that would mean we're staying pretty much above 3% until next summer at its earliest.
That's a long time above their target.
That's even longer above their target. So you're looking at this to where they're saying, okay, like the price levels are going to be a one-time shift up, but those effects are going to take a long time to work through the economy. So if you think that, and the labor market's in balance, as you say, there's some downside risks, it doesn't really make sense to cut rates. So maybe now Powell is coming along the lines of, remember a while ago, Waller spoke about, changing things up, maybe getting ahead of the curve here and, kind of prevent, maybe we act a little earlier, prevent unemployment from really spiking before waiting for unemployment to spike before acting. So I think that's kind of the change of tone, Powell took into this. And, is there some political pressure on that with everything that Trump's doing, the Krugler stepping down, the now looking into Lisa Cook on mortgage fraud, it's like, it's interesting. And if you listen to some of these other guys speak, like I think Noggle today was talking, how important it is to have, central bank independent. So I think that's the whole other side of the spectrum. And I mean, we could talk about that for hours on implications.
Yeah, I mean, that's another show. That's another show.
For another time.
My issue.
Go ahead. Sorry.
My issue with all this is, if he's now pivoting. Well, and listen, I'm using that word lightly because this may be the plan all along. Everyone's marked September on the cards as the likely next move, if there was going to be one from the Fed, some of that was being priced out a little while ago. I'd say more economists than there was the markets itself. The markets have, since that jobs data, have been full steam ahead looking for a cut in September. The economist was talking about the Jackson Hole speech and just saying, look, he's not going to change his narrative. There's no real need to change the narrative. A one-time jobs number isn't going to be the one that's going to turn him. He wants to see some kind of trend. And the argument is, well, we had a trend. It just accelerated last month to the point where there might be forward lines down like a hefty amount. And we saw that unemployment rate move up, as you said, to just unrounded or rounded up to 4.3% nearly. So where are the other members on this? You know, are they all going to start pivoting now and start thinking differently? Because, you know, the majority have been on his side of the fence, and Waller and Bowman have been the ones that have stood up for whatever reason they had for wanting to stand up and say, we now disagree and dissent. Everyone else has sort of towed the line. So is this is a hard question for you to answer. How much of this is politically motivated compared to monetary policy motivated and the economically motivated? What was the balance? What's the ratio in your opinion?
Honestly, like I will continue to say I think the Fed is trying to remain away from the political pressures of things. I think they are doing their best job with what they are given and the way things are framed to do what's right for the economy. I do truly believe that. I don't think there's as much political gains on their side as there is from the administration side, right? I think the administration side is just complete nonsense and playing a ton of games. I think the Fed and most of the members there are focused on doing what's right for the economy. I do think a few of them have changed their tone recently because there's essentially a new job opening coming up, and there's always that human nature to to benefit yourself there. So I think if I had to lean, it's definitely more the Fed is looking to do what's right for the economy, right? And I think they're in a very difficult situation because of this administration. If you did not have these tariffs, the situation would be completely different, and the Fed would be slowly cutting rates. They view policy as somewhat restrictive. Now I think that can be argued, right? How is policy restrictive with risk at all-time highs? That's something that you can debate for a while on. As far as the rest of the members of the Fed, I think it's pretty evenly split on how they are right now. And in September we get the new dots coming, the new dots, but it's pretty split between the averages of those expecting 2 cuts and some of the more hawkish members expecting 0 cuts this year. But that was on the last that projection, so that's obviously going to change at this next meeting. And I just think they're looking at the unemployment rate. We've talked about this for a while, and I think maybe now it's circulating in people's heads more. They're paying more attention to this, right? But like we spoke about, you get those deportations, and the labor force comes down, right? The participation rate comes down. That suppresses that unemployment rate. So maybe you have to look at this as where would, without these immigrations, right? Even if we had the labor force tick back up, 30 bips, let's say the Fed cuts rates, bring some people into the workforce, right? That could even, in my mind, maybe produce a scenario where the unemployment rate does come up. Because if we add into the labor force, even if we go back to where we were, in April, what was that, like right around 62.5? I mean, you put the unemployment right there at 4.5, and if it goes back up to where it was, I think at the start of the year, around 62.75, unemployment rate's almost at 5%. So I think in the last dots, the Fed had the unemployment rate at the end of the year was right around, was it 4.4?
I think I'm trying to go through the 4.4. Yeah, I think you're right. I'm going through the minutes now to see what their forecasts were. But I think you might be right, 4.4.
Yeah, so I think realistically that sets pace, right? So 2 cuts this year to me, again, now with everything Powell said, makes sense. Do I think it's necessarily the right thing to do and the right timing? I really don't. Like, I think tariffs hurt growth, but I also think now, if you look back at that last inflation report, we did continue to see that kind of stiffening up of the core goods prices, and we're not feeling the full effect of that. Now we're going to get a lot more clarity in the September inflation report on that. But what really stood out was the reacceleration in services inflation. So that was concerning to me, because a lot of the lower readings in inflation we got this year was kind of the goods reinflation happening, where we continued to experience some services disinflation. But on this last print, we saw the goods, firming up a little still, and services inflation continuing to, reaccelerate. So I think that creates problems moving forward. I think inflation is going to be very sticky, and these tariffs, slowly making their way into, the pricing. You see that from, recent comments from, Walmart and Target, and that it is going to be apparent in prices. So look, cut 25 bips, wait and see what happens. Seems like a sane approach, but I think you're at the risks now of maybe you get 2 cuts into the end of the year, right? You cut September, you cut December, but if we continue to see this reacceleration in services inflation and goods inflation continuing to rise, you risk kind of putting hikes on the table again. If the economy continues to chug along and, the fiscal impulse is high, that's could create a tailwind for inflation to pick back up in a meaningful way. And if they're looking, at the longer term inflation expectations, I think that's something that's going to be pretty evident to see.
What I would say, though, is that many people, and I think you as well, were talking about the lag in the tariff effect, and we wouldn't really see any substantive impact until we got to the September-October time. That's where we're getting into now. So, I mean, this is going to be the next couple of months worth of readings, or 3 readings really, because obviously we're a month behind, lagging in terms of the months, are going to be absolutely key for setting out the stall for the new Fed chair, whoever it may be, because they might want to come in with this dovish tone. But the simple fact is, if this tariff effect, and he says it's a one-off hit, but they've been wrong on inflation before. They've been wrong on the effects of inflation before. And there's nothing to say it doesn't last a little bit longer than it maybe should, or they calculate. And that takes us into then the next year and the new Fed chair and everything that comes with that. They could be digging themselves a hole. And I'm looking way into the future, and we're nowhere near that yet. But
it's important. There's been some really good trades in the market to take advantage of that. Like, one of my core positions has been in SOFRs in September 25 versus September 26, because we get the new Fed chair in that, and that thing is just pretty much, there's been a little volatility in that, but that thing is pretty much just flat and straight from 70 bips down to 100 bips today, and still probably has a little more juice in it. So that, we say there's a lot of this complicated thing, but it sets up some amazing opportunity in the market if you do a little bit of work on this.
Do your homework.
I know it sounds like.
I want to come onto the markets. I want to come onto the markets now in that respect then. And, as an investor, as someone who looks at these markets very carefully, how do you plan for, say into year end now? Do you come out swinging a bit more now because we've had what we've had today and Powell's speech, and that higher level of certainty will get a cut in September? Is this now a time to come out swinging, or do you
I still think there's a lot of uncertainty, and I know when we talk about the administration, the Fed, and that, it sounds like we're always kind of complaining about what they do and annoyed with it.
Yeah, we're traders. We complain all the time.
Yeah, the fact is, when you have things like going on like this, it creates an immense amount of opportunity in the market. So I'd rather have this going on than just, this typical dull summer with nothing going on, nothing to trade. You're wondering why you're spending, 8 hours a day at your desk. But I don't think it's the time to really hammer things here because I still think there's a lot up in the air. Like I said, we had Powell speak today, but we still have another inflation report. PCE is going to come in a little hotter. I think there's some risks to the upside there. At core PCE, I think my models are right
0.28.
I'm a little higher. I'm around 30, 33 bips on
Okay.
my core. I'm a little higher on that one. And again, a big driver of that has been these portfolio management fees, right? Which kind of work on basically you get a 3-month lagged effect. So this whole equity rally from Liberation Day is now coming into portfolio management fees, which is going to be a key contributor to boost, that core PCE reading. But again, my problem with this is moving forward, I do think inflation is going to be sticky and it's going to rise. And I don't see us coming below 3%. Now, I understand the labor, but again, I've been a huge, I don't know the word I'm looking for. I've been saying labor is a lot worse than it appears for a while now. And we got a print that
Doomsayer, as they call it, doomsayer.
Yeah, like
you've been an advocate for looser jobs market, basically. You've been doing that for a while.
We got that, but at the end of the day, it's one print.
Yeah.
Right. And now with Trump also, firing the head of the BLS and the oncoming data, I think there's going to be a lot of questioning on the validity of that. So I think that creates a lot of uncertainty on that front. I mean, if you look at, this isn't really my area of expertise, but, if you look at where equity valuations are, like PE ratios in the S&P 500, we're right around like the all-time highs in recent times. Like, equities seem very overpriced here. So it's very hard to want to be fully allocated to the market now with knowing that, okay, inflation could be sticky. The Fed could possibly be making an error on cutting rates a little too soon if, these employment numbers don't continue to deteriorate. So I think, the September, when we get it, what is it? September 5th. September 5th, we get the next NFP. I think that's going to be paramount, right? And I think the way you have to approach risk assets here, and when I say risk assets, I'm referring more to the equity market. If the Fed is cutting because employment is stable and inflation is not so sticky or coming down,
less than stable,
equity should continue to perform well. If the Fed is cutting because of a deteriorating labor market, I think equities have to perform poorly. And a lot of the reaction you're seeing in equities today, I think, is a lot of hedge inflows coming in from the past couple of days where the minutes were hawkish, and you kind of saw some positioning kind of put on into hedges. With that,
just by the way, the FOMC meeting, the next one we've got coming after this August one, will be the 16th and 17th. It's a 2-day meeting, 16th, 17th, and it will come with a summary of economic projections. So just so people have that date there. I totally get you in terms of the market preparedness and looking down the line. From your opinion, we're looking at a slightly hot inflationary picture. Really, and there's opportunity to set up some, there will be anomalies in that. And as I said, we've got a whole August data set to come ahead of the September FOMC meeting. So we'll have a lot more data to view way before that September meeting, as I said, on the 16th, 17th. So
I think
there's opportunity that you say.
Yeah, and I think one thing's very, very clear from recent Fed speak, the way the markets are reacting to everything, that we're going to have steeper yield curves, right? I think that is one of the best bets to play right now. Obviously, that's been, a very big macro play, but I think a lot of the macro has been focused in the wrong spots. A lot of people have been looking at those, 210s steepeners, where it's a very crowded trade, and it's had a really hard time getting going, especially past like the 60 pips area, right?
Sure.
And every time it gets there, you see some flattening here. So I think steepeners are a great way to go. If you look at 530s, those have done exceptionally well this year. And I think moving forward, it's going to be the front of the curve here in the belly. That I think that 2's5 curve presents the safest way from here, because I could see it performing and steepening in either scenario we go, right? And it's been inverted most of the time because everyone's been talking about, recession. The 6-month probability of a recession has been relatively elevated in the past couple of years. And this curve has finally come out of inversion and is hovering, right in between that, 0 bips to spiking to 20 with a median right around 10 bips. I think this is the area of the curve that presents the most opportunity right now. So I'm kind of shifting some focus into that part of the curve because I think it could benefit no matter which road we take here.
Interesting. That's good to know. Right. I wanted, before we just quickly get on to the week ahead, obviously we had the retailers report this week, the likes of Target and Walmart, and you addressed some of the issues there really that they're seeing on the high street. So we're pretty much at the end of the earnings season. It's been, I think, a fairly upbeat earnings season, but maybe that's because there were I guess some low bar sort of forecasts pushed in ahead of the Q2 numbers. But on the whole, how much do you view the S&P and the stocks in all of this? Do you think, again, it's looking a little bit too frothy, or are we really just reflecting really the reality of stuff that is until this, if this tariff stuff hits, then they'll deal with it. But for the moment, they're all doing great. They're all doing as well as they can be, and therefore there's nothing to see here.
Yeah, I think they've all reported well. Again, this isn't my huge area of expertise, but I think
no.
The bar was set pretty low coming into this earnings season. So I think a lot, beat the bar, but I think that's just because, analysts' expectations leading up to the Q2 earnings, were kind of grinding lower. And it's set a pretty low bar for them to beat. So, with the way I'm more concerned about what these companies are saying, right? Especially companies that factor into the macro right now. So like I don't usually go through like earnings reports and listen to too much commentary, right? I'm perfectly fine reading the summary from some research firm, right? Okay, this is kind of the key points here. But I wanted to listen to Walmart's, and I kind of went through there because they kind of cater in that, that median middle end consumer, right? I'm not so worried about the top quintiles of consumers, right? Because they're going to be relatively fine no matter what. It's kind of that medium and lower. And they had a very interesting point on, tariffs. I believe they said, as they continue to replenish their inventories post-tariff price levels, they've continued to see their costs increase each week, and they expect that will continue into the third and fourth quarter. So a lot of these companies did well by, kind of stockpiling their inventories, pre-tariffs. And now as we wind down through that inventory and inventories have to replenish, those are going to come through with higher prices. And now at the end of the day, those higher prices have to be paid from somewhere, right? So that's going to either come from passing it on to the consumer, or it's going to come from margin compression. And I think there's going to be a little bit of both of that.
So it's a combination of the two.
It's going to be a combination of the two. And you talk to some people, in that industry, that they've been trying to come up with ways to kind of, backdoor around some of these tariffs, whether, on your purchase agreement, you're paying X amount for goods, paying the tariffs on that part of goods, but you're, kind of supplementing some of that tariffs with a service charge. These have been a few things that I've read, but, I think it's kind of a very gray area. So I don't know how much of that will actually, come to fruition. I think it's a little sketchy. But I think that the fact that these large companies are looking at stuff like that, I think that has to give you pause for concern that, they are worried about this. Yeah,
absolutely. Right, so I want to get onto the week ahead just quickly, and it's obviously the PCE data will take front and center, but because we've had CPI, because we've had PPI, most of those calculations are in. I'll just read you from, like you mentioned as well, but from Deutsche Bank, US economists, they expect a 0.31, they were you really, month over month print for the core measure, 0.3% was seen in June, and see both consumption up 0.6 versus 0.3 and income up 0.4 versus 0.3, edging higher. So that's their view. In terms of other bits and pieces of data, over in Europe, we've got Germany, August IFO business climate. It's going to be quite interesting. That's perked up a little bit of late. I think defence spend agreed by the government has helped. The fact that we haven't seen any escalation really in any of the wars has helped as well. And the fact that we've come to an agreement with the Europeans come to an agreement with the US over tariffs of sorts will also help sentiment on that front as well. But we'll put out a preview for that as well. We'll have US durable goods orders, a flash reading next week. Over the border in Canada, we've got Canadian real GDP for Q2. And we'll get a second look at US GDP for the second quarter. Just quickly, on the US real GDP for Q2, do you pay much attention? It's backward-looking data, but will you pay it some mind because it's a second reading and expands really the research or the survey responses that they get, and it's more definitive. Do you pay any attention to that at all?
I mean, I'll keep eyes on it, of course, but I think Q3 and Q4 are going to be more important because Q1 and Q2, I think you're just going to have such skewness in the data because of these tariffs, right? And how it was a stockpile of inventories, then a rundown of inventories. I think that really skews the GDP data in the first and second quarter. So for me, it's, I obviously want to look at it and see if, the revisions hold true to, those initial prints, how much adjustment there is to it. But I think it's just a lot of noise in the first two quarters. And I think it's really the third and fourth quarter this year that are going to be more important.
Fair enough. It really rounds off a quiet end to the August period, really, pretty much. Also worth noting before we finish today, the de minimis exemption will end this coming Friday, and the 50% levy on India is to become effective on Wednesday. So tariff-wise, there's a bit more noise and a bit more happening around that. So we should keep an eye out for that as well next week. We'll have the European Central Bank accounts to come next week. They'll release those on Thursday, alongside July consumer expectations on Friday. We'll hear from ECB President Lagarde, Bank of Japan's Governor Ueda. That will be quite interesting to see where they're at the moment, where they're expected rate hikes to come. I think October is the pricing for Bank of Japan. And we'll hear again from Bank of England's Governor Bailey, who will also speak on the final day tomorrow. He's speaking on Saturday. So we'll hear from BOE's Bailey on Saturday. With the Bank of England now, that's a whole nother issue and episode that we'll go into nearer the time about where the Bank of England is on its rate cutting cycle, if it will continue to cut rates, because it was a very narrow decision last time out. So it'll be interesting to see what he has to say tomorrow at the symposium. With that, I'd like to thank Sam. Sam, thank you very much for your insights as always.
Always a pleasure, Harry.
Brilliant. Thank you very much. Thank you guys for listening. And we'll post this up. This will go out again this Friday, the 22nd, for your pleasure. And tune in again next week for another update on all things financial markets. Thank you for listening, and goodbye.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.